Okay, it is the beginning of a new month, March 3rd right now, so it's time to look back at the previous 30 days, see how my dividend growth portfolio performed, how much dividend income I raked in, and then I want to compare that performance against what if I just go all in on JEPI? Because JEPI is one of those ETFs that is just blowing up in popularity. So this article says here that of the top 100 ETFs in terms of flows year to date, only 12 are actively managed funds, but one in particular stands out, the $21 billion in assets under management that JEPI has. We can see here on the chart of actively managed ETFs that year to date fund flows, JEPI is just head and shoulders above all the competition. So this should be a fun video. If you guys enjoy, I always appreciate a like, subscribe for more content, and let's do this. So the portfolio has a current value of $45,203. And if we filter by the past 1 month, my portfolio is down 1.52%. Again, if we use the S&P as a benchmark, the past 1 month, this is down 0.74%. So unfortunately, in the past month, we don't have the best performance ever, but I'm still generally happy with my portfolio. It generates a ton more income than the rest of the market. And on top of that, some months the portfolio does do better than the rest of the market. Now, focusing on the income, I have 3 ETFs that pay me on a monthly basis: Divo, BST, and JEPI. These are the 3 names that paid me a dividend last month. And I gotta say, looking ahead to March, I'm super excited because SCHD, VOO, and VGT are gonna be joining the party. Now, if we come to my activity page and filter by dividends, out of those 3 names, so far this month, only Divo and BST have paid me a dividend. And that's just because these names tend to pay a dividend at the end of the month, and JEPI is always a couple of days late. But JEPI did already declare their dividend, and it comes in at 41 cents per share, which is a little bit disappointing. If we take a look at the historical chart, now for the past 3 months, the dividend has been pretty sharply declining. I'm not getting alarmed quite yet, but if this trend continues for another, even just 1 month, let alone 2 months, then I'm going to get a little bit more concerned. Ideally, next month we have a reading of something like 50 cents per share, and that would be a lot better. So those 3 dividend payments together last month equals a dividend income of $132 for me. Now, compared to another comparable month like November, we're a little bit down, and that's mostly due to JEPI, unfortunately. But going all the way back 1 year to last February, I received $113 of dividend income. So this is an increase year over year. And when it comes to the actual value of my portfolio, as we saw, it was down slightly for the month. But now, the moment you guys have all been waiting for: what happens if I ditched all this complexity of having 6 different ETFs and just went all in on JEPI? Is that a good idea, and how would my returns be in comparison to this more complicated approach? So to quickly cover the basics, JEPI is a defensive, actively managed portfolio with a cover to call strategy to boost its monthly dividend yield. And the 3 major objectives of JEPI is to have consistent monthly income at a high level, low volatility in price, and to have long-term competitive total returns to the general market. And here's how JEPI tries to accomplish this. So in terms of its sectors, it's heavy into finance, consumer non-durables, and healthcare technology. That gives us exposure to companies like Progressive, AbbVie, Hershey, MasterCard, Travelers, Coca-Cola, Pepsi, Visa, all these very recognizable, relatively low growth and stable blue chip names. And taking a quick peek at MasterCard, one of the larger holdings in JEPI, here's a look at some vital info: the revenue of this company, the earnings per share, the free cash flow per share, and the dividends per share. All in all, this is a super healthy looking company, and JEPI has 100 other of these very high quality companies. But quickly comparing that to the S&P 500, the biggest difference here is that you are missing out on the large technology names like Apple, Microsoft, Amazon, which according to many are some of the highest quality companies there are. Now, taking a look at some of the hard numbers, you have to keep in mind that JEPI is not an old ETF. It's post-COVID. So that's why this time frame here is the entirety of 2021 up until the modern day. The blue line is JEPI, The red line is the S&P 500, and the yellow line is good old SCHD. So during the bull market of 2021, JEPI was notably behind the other two options, even SCHD. But then in 2022, JEPI did a much better job of retaining its value. It still did dip, but JEPI closed the gap from being about $700 below the S&P 500 to about $700 above the S&P 500 with an initial investment of just 10,000 bucks in each. But again, keep in mind the rather confined time frame here. Oh yeah, not to mention SCHD in yellow here outperformed both of them in all the time frames. But of course, a big reason people invest in JEPI is because a big portion of the return is paid to you in the form of those dividends. And here's how that dividend income compares. And it's pretty clear that JEPI is the clear winner here. So now the question is, how does JEPI compare against my entire diversified portfolio? So I went ahead and inputted my current portfolio. It does consist of JEPI as one holding out of 6, but then I have other names including Divo, SCHD, VGT, and BST. The weighting is pretty equal between all of these. And then in portfolio 2, we have just JEPI. And with the same limited time frame, here is the corresponding performance. My portfolio is in blue and JEPI is the red line. So in 2021, my portfolio did have a slight edge with more growth characteristics than JEPI, but during the bear market, my portfolio hasn't fared quite as well as the defensive JEPI. Now in terms of the income, my portfolio has a combined dividend yield of about 5%, which is well above the market average, but it's still behind that of JEPI, which I think right now it's about 11%. So based off of that data, it does seem like I should go all in on JEPI. It did produce more income than my portfolio, and the performance was a little bit better as well. Well, if you're asking me, I don't think this is a great idea, mostly because of the actively managed nature of JEPI. So in the past couple months, this has been a great positive of the ETF. It's outperformed the market in this rather difficult time. But all it takes for JEPI to drastically underperform, cut its dividend, is for the active management to make a mistake. So far that hasn't happened, but remember, JEPI is a very new ETF. That historical data only went back 2 years. So in my opinion, the odds that management eventually will make a mistake are pretty high, if not inevitable. And that's a major reason why in my portfolio I invest in 6 very different ETFs. So I have a good combination of passive market indexes as well as some actively managed funds. But the key thing here is that each one of these actively managed funds is from a different company. They have different strategies and approaches. So if one of them fails in their active management, it's very unlikely that the other 2 are also going to fail in theirs. I'm always looking to improve my portfolio, have better returns, lower risk, more income, but as of right now, I think my portfolio long term is probably gonna be better than just JEPI. But of course, let me know your thoughts in the comments. If you guys are still watching and enjoyed, leave a like, subscribe, and I'll see you guys in the next one.